in Asia, and we're looking this morning, Thursday, October 28th. The market is down in open in Asia, down $1. Brent is trading at $83.50, so clearly come off its highs and has been sort of struggling to really break free of that 85 and move higher. Let's start this morning with Neil Atkinson, the former head of oil markets division at the IEA. Neil, we have expectations later today that the U.S. Department of Commerce will come out with its quarterly report and show that the U.S. economy slowed down somewhat significantly in the third quarter. COVID is still with us. Your thoughts?
Oh, absolutely. COVID is still with us. I'm heading to England tomorrow morning with dread because COVID is still a big factor there, and it's a big factor still in many other parts of the world. It's a huge uncertainty. I think the Saudi minister mentioned this the other day as one of the factors behind their and OPEC Plus's cautious approach. So I'm not surprised that some of the expectations for heady growth as we come out of COVID are being dialed back as we actually see the reality.
Let's welcome Kate Durian, a former colleague of Neil's from the IEA. Kate is now Meese Contributing Editor and Non-Resident Fellow at the Arab Gulf States Institute in Washington. Despite the COVID challenge that remains, England and Britain, as we know, is fully open. But while there might be some sort of cap on the oil price with COVID still lingering, Kate, all other financial markets seem happy to tear on. We see equities still breaking records every day. Confidence does still seem high.
Yes, it does, and as you know, that's one of the problems that that the oil producers and economists are facing, is that we have, this push and pull, talk of stagflation, fear of inflation because of all the stimulus packages, raising the possibility of raising interest rates. So it's very difficult to gauge, how markets are going to move forward. Equities are going up and down, and it's a very uncertain time. I mean, I came back from Paris, and you have to fill out all these forms. I mean, traveling has become so complicated. Every country has different rules, and you've got to be tested before and after it. Half the time they don't even ask you. So I think it's very hard to see. But you talk about oil prices down $1, but they're still above 80. So I think this was probably, the dip was a reaction to the rise in US stocks. But it's still a market where you see demand could be because of the gas shortages, because of the gas crisis in Europe, could be because of heating. The winter season is sort of starting. It's getting cold here. I've got the heating on in London, so I think it's hard to say where we're heading, but it's obviously a pretty tight market. And of course, with COP26 coming up, people are expecting something to come out of it, even though, when you think about it, it's the 26th and we haven't really progressed that much on climate change.
26 is getting gray hair. Let's welcome Matt Stanley, who doesn't have much gray hair, it would have to be said. So one has to put a question to where the bottles in that bathroom are. But nonetheless, Director of Star Fuels, Matt Stanley, U.S. oil inventories growing more than double the expectation, somewhere above 4 million barrels of growth in inventories there. It feels a little bit counterintuitive.
Yeah, look, I mean, it hasn't. The morning, by the way. Last few weeks, crude stockpiles have increased in the US, but it's products that the market is looking at specifically. End user demand. Gasoline drew last week, so that was somewhat supportive. But look, the market didn't need much of a catalyst to sell off, and we traded down this morning to a low of 82.40, and we're back up $1.50 from that low on the back of not a lot. It just seems to be the way the markets are at the moment, is that, there's, like Kate said, this push and pull, and, the argument between stagflation and inflation. Most refiners and traders had an epic Q3. Summer demand, things were firmly in the rear view mirror when it came to COVID. But as Neil said, it's still with us. And as Kate said, travel has become a lot more complicated, to the point where my mother came over and she's here for 3 months. Last time I saw my mother for 3 months, I was being told to pick up my washing. So look, it's positives and negatives, bless her. But yeah, look, the days, listening to the guy at Heathrow on Tuesday, air travel demand is still only 40% of what it was compared to 2019.
Exactly.
And he doesn't see full demand coming back until 2026. So, this can is being ever kicked further down the road when it's coming to end user demand. But look, Sean, the rally.
Well, what would oil prices be? What would oil prices be, Neil Atkinson, if indeed air travel was back? I mean, we're bouncing off 85 and moving higher. I mean, the momentum still seems to be there. As somebody said yesterday, you got to go lower to go higher to sort of do that final ascent up to 90. Clearly, demand is still solid.
Well, if people were foolish enough to actually want to do lots of long haul air travel, I think you must be crazy.
Well, we hope there's a lot of fools that will come to Dubai because we've got lots of beaches and 5-star hotels and
lovely. Well, I won't be coming, I can assure you.
Expo 2020, which, believe me, everywhere in Expo is full at the moment, much to, I think, a lot of people's surprise.
Well, I'm amazed. But I mean, if air travel had rebounded, then clearly we would be having further upward price pressure. But if that had actually been the case and overall demand was recovering faster than we already see and looks to be even faster into 2022 than we already see, then on the supply side of the balance, I would have thought that the OPEC plus countries would have adjusted accordingly because it is not in their interest to see a rapid ramp up in oil prices. We've seen from history that short, sharp oil price shocks are not good in the end for the producers. So yeah, the aviation sector is still the big missing piece, if you like, in the demand recovery jigsaw puzzle. But it does look as if we are going to have to wait longer for that to come back. And Matt's thing about 2026, I mean, that does sound quite extraordinary, but it's not wholly surprising.
Kate, COP26 obviously is on your doorstep in the Britain starting on Sunday. Do you think that acts as any kind of wet blanket on the oil price, moving higher? Clearly, the expectations for COP26 being a transformative event is declining, but still it does offer a challenge to the future of fossil fuels.
Well, yes, but wait and see what happens to jet fuel when 25,000 people fly into Glasgow, which I don't know how they're going to accommodate it. But hey, you don't have China, you don't have Russia. When you think about methane emissions from Russia, they're the highest in the world. I think China, is slowing down. It's searching desperately for coal and LNG. So I think one of the reasons why maybe the Saudis sort of seem to be playing two games. The Saudi minister says there's no need now to increase beyond the 400,000 barrels a day per month that we agreed on the OPEC plus. And at the same time, behind the scenes, they want to water down any reference to, the faster, the move away from fossil fuels. We see Shell under pressure, but we had a webinar the other day at the Arab Gulf Institute, and one of the speakers said, when you talk about the fact that all these economies in the Gulf are transitioning, yes, they are transitioning. They're talking about hydrogen, they're talking about more renewables, but renewables make up 0.5% of their total primary energy supply. And it's very difficult to see how the region that has the lowest penetration of renewables is going to be exporting green hydrogen. So, obviously they want to preserve the role of oil and gas with perhaps carbon capture and storage. But, even in the most pessimistic scenarios, the net zero scenario by the IEA still sees a role for oil and gas in 2050, despite all the net zero pledges. So, the signal to oil producers that, we don't need to invest in new capacity, of course we do. Even if we don't invest in new greenfield projects, you still have to stop the decline, natural decline.
Kate, let me ask you on that point of the Saudi energy minister maybe speaking, out both sides of his mouth, so to speak, the idea that, next year looks uncertain and so forth. Seems to me that that's kind of language is really to make up for not picking up the call from Joe Biden. He's got to come up with something that feels a little bit like an answer to the Americans without it being an answer. Your read on the US-Saudi geopolitics around energy at the moment, clearly the Saudis are not responding to the Biden administration at this time.
Yeah, again, it's not just on energy. It's, the whole alliance has shifted. They look more to China now than they do to the United States. It's Chinese demand that really makes a difference. And of course, with the possibility that Iran is going to come back to the negotiating table, possibility that Iranian oil will come back next year. So I think all of them are sort of positioning themselves. But from the start, OPEC was seeing the possibility of a supply outstripping demand in the first quarter of next year, 2022. So that's their caution. If there is a sort of a monthly blip because of the gas to oil switching, that's not something that they're going to react to, because they're looking more long term. This agreement lasts until September next year.
Matt, we have the Japanese story on our digest this morning. The Japanese utilities asking refiners for extra oil. This switching away from LNG in Japan. I think Japan's still the world's biggest LNG market, maybe with China now, but nonetheless a very big LNG importer looking for further switching. How significant do you think that will be over the coming months of the winter in terms of the call on oil?
Well, I think one of the stories that really, excuse me, was buried yesterday was, Putin has told Gazprom to, once they've finished, filling up the storage tanks within Russia, rightly so, they've got to look after themselves first, then they'll look at the European storage there. So I think that, that general rhetoric regarding this panic around the gas market is waning somewhat. And I think that will slowly filter its way down and dilute its way down to the big buyers like Japan. The oil power generation in Japan, I think, only is less than 1%. They used to be big fuel oil buyers. Now they're obviously more gas. JERA are the world's biggest buyers of LNG. So I think the overall panic, you think you're buying a cargo now, if you're looking for a cargo now in January, or if something that's loading now, one of these big gas carriers is going to take 35, 40 days. So we're within the trading cycle that it's going to take sort of 6 weeks to 8 weeks. I think that it will slowly dissipate. It's starting to come off in general. The overall energy complex is a tad weaker, still very high. Let's go back to the earlier point that Neil was making as well, and Kate touched on, if demand was there as it was in 2019, then we would be a hell of a lot higher than we are at 85. The rally has really been, since this time last year, has been the catalyst was the vaccine and demand coming back, but ultimately it's all down to supply curtailment, and that's really what the oil market's keeping itself on. And gas has unfortunately been a sort of secondary issue there, because not as much oil, there's not as much gas. So that's where we are.
Neil, where do you fall on that? And particularly from the European perspective, facing shortages this winter. We have another story on our digest today about Moldova literally has a gun to their head. Their only supplier of gas into that country has ever been Russia. They've just, for the first time in their history, taken some gas from elsewhere in Europe, but they're still trying to do a deal with the Russians, but they're basically saying pay up.
Well, Moldova is in a tough position because it's tried to pivot more towards the West, to the European Union, and it's got Russia on its doorstep supplying all its gas. So it really is in a very tough spot. But ultimately, the answer to this shortage, to use your phrase, is the weather. And we're even worse, probably even worse at forecasting oil prices than we are than the weather. But I mean, the weather is going to be a huge determining factor. So far, this season, the early part of the season, despite Kate switching on her central heating, which doesn't surprise me, frankly, but here in Paris, it's certainly been fairly mild so far, and the weather will be the big determining factor. If we get, an Arctic blast or whatever they call cold weather these days, then yeah, we could be into problems. But the stocks have been filling up to some extent here in Europe from what was perceived to be very low levels. And I think the Russian supply will increase simply because Russians, they want to make money. They've got this huge supply available, or more supply available, the prices will be attractive. They will want to
So
sell it.
where does this two things sort of intersect, Neil? Of course, they've always want to make money, and God knows they'll probably make a lot of money this year between oil and gas. But nonetheless, there's no better man at the chess game of geopolitics than Mr. Putin, and this is clearly an opportunity to put a squeeze on the new German government that's still being formed.
Oh, possibly he may choose to do that, but ultimately, I think the money will win out. And he can, always wait till next year or the next circumstances when the gas market is tight for whatever reason. This issue of a big dependence on Russian supply isn't going away anytime soon. So he's a chess player, as you said.
Kate, looking forward, I mean, the 400,000 barrel per day per month increase from OPEC Plus has been stuttered and started, if you like, over since it began in August. August, they didn't make it. They seem to catch up in September, now October. Does OPEC Plus indeed have that idle capacity to bring 400,000 barrels back every month through to April? There seems to be some uncertainty around that, and hence I think the tightness and the squeeze on oil prices upwards. Your thoughts on that?
No, we still have ample spare production capacity. I mean, it's coming down as they increase production. Some countries are unable to meet their new quotas, and more will be added as you ramp up, into next year. But you're still going to have 5 million barrels per day of spare production capacity in the first quarter. Maybe down to 4 million barrels a day in the second. So it's not really that tight, except it's concentrated in just a few countries. It'll be UAE, Saudi Arabia, Iraq, possibly. Kuwait is struggling. If you look at the latest numbers from Kuwait Oil Company, they're struggling with their own production and the neutral zone production. So the number of countries that haven't invested enough in their upstream or haven't created the right environment for investors to come in are struggling with production capacity. And
I think that's kind of the point, isn't it? Yes, there is the capacity there, but it's not spread across these 20 countries, and yet the agreement does paint it across these 20 countries. There is a bit of a disconnect in the sort of validity of the agreement. Yes.
I mean, that's one of the reasons, I suppose, why the market is tighter than maybe it should be on the supply side. We talk about the switching to from gas to oil. If you look at it in millions of barrels of oil equivalent, gas is a lot more expensive than oil at the moment. If it's over $100 at 26, 27, or 30 on the spot market. So that kind of explains it. Things will balance out. We don't know about US shale. Is it going to come back at 80 plus per barrel because costs have come down? Yes, there will be more discipline within the shale patch, but there's
I think it looks to me like the shale producers, the big players now, Exxon and Oxy and others, are as disciplined as Saudi Arabia is in keeping that new supply tight, because they're obviously about to announce some mega numbers of profit in the coming days. The third quarter delivered them some serious cash flow. What do you expect them to say? What do you expect them to do with all that money?
You're asking me?
Matt.
Sorry, no, please.
All of us. No, Kate, go ahead. It's fine.
No, you go. All
right.
I mean, will it give some confidence to that Capex outlook, which has been very sour in recent months?
I think they've needed to consolidate balance sheet since prices hit minus $37 a barrel last April. That's clear. That's economics 101. The shareholders will want to see that consistency and that growth, and that trajectory has been there for the last 15 months. So it's a matter of time. I don't think we'll get up to the 13 million barrels a day. I think that was a little chaotic. But Biden's energy policy is not conducive to big oil in the US. But it's clear that the Chevrons, they came out yesterday saying that the renewables is not something they're particularly interested in investing in. They're making money at the moment, as Kate said, consolidating balance sheets and costs, making their current system ever more efficient, which is going to increase the bottom line. you would invest in that all day long, and the funds are, and that will eventually filter its way down to the wells and to exports. We're at 11.3 million barrels a day of production, back to where we were last April. The rig count is up to those levels. I think we'll see another 500,000 barrels come back by the end of Q1 next year. I think that's not out of the realms of possibility. And the world, if you look at it right now, the world needs the oil. So it's not an issue. But, and Neil touched on this a couple of weeks ago, the market is concerned what end of Q1 looks like for global balances. OPEC, just on OPEC balances coming back, and where demand is, which is, I would say, plateauing right now. Demand is hit somewhat of a ceiling, but supply is going to come back. What happens to those balances, say, from Q1 to the middle of next year?
Exactly.
The US oil producers will have their eyes on that. So,
Neil, your thoughts on that?
Yeah, absolutely. I mean, as Matt said, I've been talking about this for some time in various meetings that I've been in. You look at the agencies' outlooks, the IEA, the EIA, OPEC, and indeed some of the others from the investment banks. And we are looking at the peak of demand, the recent peak we've seen in the summer season, that is easing off as normal. As we move into 2022, demand will fall away from the winter peak, complicated by what may happen in terms of the gas oil substitution story. But we are going to see some more production from the United States. As Matt has suggested, the trend is there for an increase as we move through into 2022. We're going to see more oil next year, probably from Brazil and from Norway and from one or two others. And also, we've got the planned increases from the OPEC Plus countries. Now, if you assume, for the sake of argument, the OPEC Plus increases do happen in terms of the actual volumes they promised, the demand outlook does ease off for seasonal reasons, and we get increases from countries outside of the OPEC Plus agreement, that is a recipe for surpluses as we move into 2022 and through the year. So, the Saudi minister again has suggested this as an outlook and a reason to justify the cautious approach that they and the others have adopted.
Let's go to the survey question and give everybody in the room a view this morning. The U.S. economy likely grew at its slowest pace in more than a year in the third quarter as COVID-19 infections flared up. That's the outlook from the U.S. Commerce Department, which is expected to report later today a slowdown in GDP. My question is, will COVID-19 still be a factor in curtailing economic growth in 2022? And this question of the outlook, the cautious outlook of OPEC Plus, and also echoed by Neil Atkinson this morning, will COVID-19 still be a factor in curtailing economic growth in 2022? Big question. I suppose the answer is inevitably it will be somewhere, and other places it will not. Kate, looking forward to the sort of immediate sense of market direction, as we said at the off, we're down a little this morning. Inventories building in the U.S. This week and over recent weeks. Where do you think the sense of the market momentum going into the rest of the fourth quarter?
I think part of the inventories build is because they were pretty low, after Hurricane Ida in the US, and refineries were shut down. So I think that was, it tightened products markets and dipped into storage. You had strategic reserve draws in the US and in China as well. There may be more to come, and I think that may have been a signal from China. Okay, yes, testing their strategic reserve method, which they hadn't done before. But also a message that, hey guys, we don't particularly like prices at these levels. So, OPEC beware. But I think OPEC Plus seem to be comfortable with prices at these levels. I think if you look at, going into 2022, now there's a lot of talk about supply chains and, shortages and supermarkets being empty, but it's very difficult to gauge because you see a lot of Halloween and Christmas stuff piling up on supermarket shelves, but not basics like even bottled water. So I think it's difficult to tell how it's going to develop, but COVID is still with us, and I think we're just learning to live with it. So I think economic activity will probably continue, but it came from a low base in 2020. So we will see.
Matt,
Smaller.
the COVID piece of COVID still being with us, also still with us, is this: are we making a shift to a sort of a tightening phase in monetary policy, where the Bank of Canada signaling overnight that they indeed may move quicker on rates hikes than expected? The US Fed is also expected to at least begin to taper at some point in the coming weeks before the end of the year. Does this potential shift from ultra loose to start to tighten have a consequence for the oil markets going forward in the immediate term?
Well, I mean, beer duty got slashed yesterday in the UK for the first time I think I can ever remember, and cigarette consumption went up in the US. So I think we're going back to the 1930s. It's great, Sean. I love it.
1970s, stagflation, and queues at the gas station, and no tax on fags.
Yeah, look, it's I'm joking, of course, but it's a terrible habit. I should give up. No, but it's a change in, people are coming out of COVID now. It's still with us. It's been with us the whole time. You've had to search for news. But as Kate said, we have to learn to live with it. It just shouldn't be dismissed. It can't be constantly in the rearview mirror. I mean, we're lucky here in the UAE that the policy has been so positive and confident that we're below 100 cases a day. Whereas Western Europe, as Neil was saying, dreading going to the UK tomorrow because cases there are 40,000 plus a day. It is a concern, and it will be a concern that most people have. Would it have an effect on monetary policy? I think it will. I think it will continue. Jerome Powell will continue the rhetoric that he's been, which is one of caution. Bank of Canada are always a bit more hawkish than their friends over the river. But it's I don't see it. US policy, which is what the rest of the world will really follow or look at, shifting anytime soon. COVID is still with us. It will still have a downward effect on demand, on oil demand in general. But yeah, look, as things need to stay tight, inflation will need to be watched carefully. It all lies on what Powell does, really.
Let's get the survey result and give Neil the last word this morning. Will COVID still be a factor in 22? Overwhelming yes in this room. Your thoughts, Neil, on that? We've talked about COVID still being with us. The monetary policy shift, the idea that inflation is getting away from us, and we are also expected to hear later today from the U.S. Commerce Department their inflation numbers, which are expected to be quite high.
Well, I think they'll continue to be cautious, and they should be. I think one of the factors behind the pressures in logistics and the pressures on the supply of various materials and labor is because we shut down the economy essentially in 2020, almost overnight. And in large parts of the world, there were huge shifts of migrant labor from where they work back to where they live. For entirely understandable reasons. And we have yet to see a full readjustment and a rebalancing of the system. I think on the assumption that the COVID crisis doesn't return big time, that rebalancing will start to happen. We'll start to see normality resume in supply and in logistics. And I think these inflationary fears will start to ease. That's my opinion. If that is the case, then that justifies a very cautious approach from the central banks. And I think that cautious approach is what we will continue to see until the picture becomes clearer.
Well, they won't be easing for a few million Brits who got a minimum wage pay rise in the latest budget by the UK Chancellor of the Exchequer, Mr. Sunak, now $13 an hour in the new minimum wage in the UK. You might say they're just catching up, and there's a lot of space there, given minimum wage has been so low in the developed economy, certainly in the US and the UK. The US still at a federal level at $7.50. So I think a lot of inflation capacity to absorb absorb higher minimum wage before the monetary policy makers may act. Nonetheless, there is a challenge there they need to face, and we will see if Canada does indeed join New Zealand as the next country to raise rates. For now, we'll leave it there. Oil markets in Asia open down $1 today, recovering earlier deeper losses, it has to be said, as Matt pointed out, but still off the highs. We see all above $85, trading around 83.50. Matt Stanley from Dubai, thank you so much. Kate in London, Neil in Paris, thank you guys for your thoughts and insights this morning. The end of the Middle East week here. We'll have to see where all things go. COP starts on Sunday, as we do, with a new week of the podcast. All the best. Have a great weekend.
Cheers.
Thank you.